As predicted, we have seen some switch in investor funds to well-funded, cash-flow generating companies such as Air Arabia, Aramex, DP World, Etisalat, DO and Gulf Navigation, with share prices all increasing in spite of the market falls last week. This week we've seen some stabilisation in both Dubai and Abu Dhabi bourses based on positive news from externally, and also stock prices falling to a point where buyers are starting to enter the market and turnover is increasing based on the risk being factored into stock prices at these lower levels. As at December 6th, the DFM index has stabilised by 1.2% to 1853, and the ADX rose by just over 3.9% to 2673, reflecting greater investor confidence in the short term. The real litmus test will come when foreign investor markets open on Monday trading, and we see foreign fund managers readjusting their portfolios depending on their new attitude towards risk in the UAE. In either case, we see good gains to be made in fundamental long-term stocks such as the DFM, Dana Gas, Aramex and DO, and also some of the preferred Abu Dhabi stocks such as Agthia, Etisalat, Abar, based on valuations looking more attractive over the long term. In the very short term, we think that there is strong volatility likely in these markets over the coming weeks as more news comes out regarding which assets Dubai World is looking to restructure, the Dubai government's response to its new bond issues to Abu Dhabi, and more disclosure and transparency on where these funds are going, and also the exact exposure of UAE banks to Dubai World and how much they will need to provision for and write down their net profit by next year as a result. We shall now look at our individual stock recommendations and how they have changed based on this new credit market developments from Dubai World. For construction company Arabtec, we've reduced our 12-month price target to 3.67 per share from 4.18, based on the company having around 15% of its projects stemming from the Dubai government and quasi-government related entities, including Emaar and Nakheel. We believe that the negative sentiment floating from Dubai World and Dubai government related entities will keep the share price down for some time. However, long term there still is good value in Arabtec, as it has a strong presence and a growing presence in the GCC and potential for strong earnings uplift next year based on the Russian project or part of it being approved. For DP World, we retain our 55 US cent price target and overweight recommendation. Although it is 77% owned by Dubai World, it is excluded from any restructuring of debt and or company, and is a very profitable standalone ports and shipping container business. It has over 70% of its earnings stemming from emerging markets and has a very stable funding structure with around $7 billion of debt, and much of this locked into long-term sukuks that don't mature until one in 2017 and one in 2037, really underlying the company's stable funding position. Therefore, the share price weakness is purely sentiment alone, as the company does not have any loans to or from Dubai World or Nakheel, and we see any share price weakness as a buying opportunity in DP World. For Aramex, we retain our overweight recommendation and 2.52 price target. Despite the gains in trading last Tuesday and also Sunday the 6th of December, Aramex still trades at a steep discount to our price target. The company combines a defensive business model also with a growth element of acquisitions, partnerships and opening new offices offshore, and also has a very defensive nature of its cash flow, providing ongoing earnings growth during 2009 and 2010 at a time when many other companies are experiencing earnings compression. We believe that Aramex will continue to gain investor support as a defensive stock in the UAE and see good uplift in the short and medium term. For Air Arabia, we retain our overweight recommendation and price target of 1.33 per share. Similar to Aramex, the company has no direct exposure to Dubai World, and falls in the share price have been largely sentiment driven. The company has a very defensive nature of its business, in that it is a low-cost carrier, and there has been some transition of market share to low-cost carriers from the full-service airlines here in the UAE. The company also has an expansion platform through new terminals in Egypt and Morocco, plus flying new routes out of its Sharjah hub at the moment. We're also looking for the company to pay out a fairly decent dividend in early 2010, which could equate to as high as 6 fils per share, which would represent a yield of around 7% on current pricing. In regards to property developer Eldar, we've become more negative in the short term. However, we retain our 12-month price target of 5.71 per share, an overweight recommendation. We just believe that it will take longer for the price to reach our target than we did before. Eldar has been sold down heavily as a result of these credit market developments, largely because the UAE property market is likely to continue to slow and suffer from a lack of confidence because of these credit market developments. And also the company is very highly geared, has a net debt to equity ratio of above 125%, which represents a less than stable funding position. The company has a lot of projects underway over the coming 2 or 3 years that require ongoing capex and are funded by debt, which has become increasingly expensive, and therefore we need to factor this into our valuation. Investors can look to exit Eldar and buy on lower levels, where we expect the stock price to stabilise based on the company's leverage to the long-term growth of Abu Dhabi, its government shareholdings, and the large quality projects it has currently underway in Abu Dhabi. For Dubai financial market, we retain our 2.22 price target over a 12-month period. The stock is likely to remain relatively subdued in the short term based on lower turnovers from UAE stockbrokers and also reduced confidence in UAE equity markets. However, long term, it is the premier exchange of the GCC region, has a strong market share and is a very strong cash flow generating exchange, which means that its profitability is very sound. So long term, we believe that investors can look to pick up the stock on weakness and hold through the cycle. DFM, as well as Air Arabia, is forecast to pay some kind of a cash dividend in early 2010. At the moment, we believe that it could be close to 6 fils per share, which on current pricing also equates to a yield of between 2 and 3%. The exchange trades on similar multiples to developing market exchanges in Singapore and Hong Kong, which we believe is reasonable given its position as a hub for capital entering not only the UAE but also Saudi and Qatar and other regions around the GCC. In the banking space, First Gulf Bank has been sold down heavily over the last 2 sessions before bouncing back on the 6th of December. It has been sold down because of speculation that it has exposure to Dubai World and Nakheel of around 4 billion dirhams. However, the company has, in a press release, stated that its exposure is there, but it is many times less than what was stated in these media reports. Therefore, if we assume that the company has 1.5 billion dirhams worth of exposure and has to write down, say, 20% of this due to non-performing loans, which would be broadly a worst-case scenario, this would dilute our 2010 net profit by 9% and make net profit flat for next year. We therefore believe that investors can look to exit based on this negative earnings sentiment and re-enter at lower levels. First Gulf Bank remains a very strong bank with a high capital adequacy ratio and strong balance sheet ability to absorb any write-downs and pressure based on Dubai World and Nakheel Holdings, and therefore we retain our 12-month price target of 9.38 per share and believe that the stock will begin to rebound over the coming weeks as investors look to invest in quality banks, of which First Gulf Bank is at the top of the pile. So that's all in a very eventful week on the UAE stock markets. Happy investing, Ilarika, and sayonara!